Hey everyone, welcome back to Corporate Decoder. Today WGRX just filed its preliminary proxy statement for its annual meeting, and I'm seeing a lot of changes that could really reshape this company. Quick note, this is not financial advice, just my take on public filings for educational purposes. They are planning a name change and a big equity plan, which could signal a major pivot for Wellgistics Health. Alright, let's dive into this proxy statement from Wellgistics Health Incorporated, ticker symbol WGRX. This filing is essentially a heads up to shareholders about the upcoming annual meeting and the important votes they'll be casting. The company is filing this as a preliminary proxy statement, meaning it is not the final version yet, but it gives us a clear look at what management wants to discuss and get approved by you, the shareholders. The company's current name is Wellgistics Health Incorporated, but, and this is a big one, they're proposing to change that name to Data Incorporated. You can see this right here under proposal number 1, the name change proposal. They say this new name better reflects their current business model and strategic focus, which sounds like a shift towards healthcare technology and data-driven solutions. Think of it as shedding their old skin to fit their new game plan, especially with I in the new name, suggesting a big push into technology. This isn't just a cosmetic change. This proposal to amend their fundamental governing document, the Certificate of Incorporation, requires shareholder approval. If it goes through, their stock ticker might change too, and they mention a potential new symbol, MEDS, which is a pretty strong indicator of where they see themselves heading. This name change, in my opinion, is a clear signal that they are trying to rebrand themselves as more of a tech-focused healthcare company rather than just a pharmacy retailer. Next up, proposal number 2. They want to authorize 1 million shares of blank check preferred stock. Now, what does blank check mean? It means the board of directors can decide later exactly what those shares will look like, what rights they'll have, and how they'll be used. This gives the company a lot of flexibility. They can use these shares for future acquisitions, strategic partnerships, or even to raise more capital down the line. It is like giving the board a blank checkbook to issue new types of stock with special terms, potentially for any strategic move they deem necessary without needing shareholder approval for each specific issuance. This is often a move made to prepare for significant future corporate actions. Then we have proposal number 3, which concerns their equity incentive plan. They want to amend the current plan. The details here are pretty significant. They're proposing to increase the annual share increase from 3% to 20% of outstanding shares. Think about that, a jump from a small annual addition to a potentially massive one. This means they plan to issue a lot more stock to employees and executives over time. This is meant to attract and retain talent and also to align their interests with shareholders. However, a 20% annual increase is quite substantial and could lead to significant dilution for existing shareholders if not managed carefully. On top of that, they want to reserve an additional 6,000 shares of super voting preferred stock. This ties into proposal number 4. Proposal number 4 is really interesting. They want to create a new type of stock, series of super voting preferred stock, and issue it to certain directors and top executives. Now, super voting means each share of this preferred stock will have a ton of voting power, specifically 10,000 votes per share. This is a massive amount of voting power compared to common stock. The idea here is to give key insiders more voting control, which they say will help with long-term strategy and prevent short-term market pressures from derailing their plans. However, this also significantly concentrates voting power in the hands of a few, which can be a red flag for governance concerns. They are also giving it very minimal economic rights, like a tiny liquidation preference of just $0.0001. So the idea is to boost control without diluting the economic value for common shareholders. But remember, shares with super voting power are often seen as a mechanism to entrench management. Proposal number 5 is the election of directors. 5 board members are up for re-election, and the board is recommending you vote for them. We'll look at who these directors are under the corporate governance section. And finally, proposal number 6 is to ratify the appointment of their auditor, Suri & Company. This is pretty standard stuff, essentially asking shareholders to approve the company's choice of accounting firm. So, who gets to vote on all of this? It is the shareholders who are on record by the close of business on the 22nd of June 2026. This is called the record date, and it is crucial for determining who has a say at the meeting. You have several ways to cast your vote: by mail, by phone, online, or even virtually during the meeting itself. They really want to make it easy for you to participate. The meeting will be held virtually again this year. All you need is your control number from your proxy card to log in and participate. Let's talk about the numbers. As of the record date, there were just over 2.6 million shares of common stock outstanding. This is important for understanding the voting power for each proposal. A proxy, in simple terms, is like giving written permission for someone else to vote your shares on your behalf if you cannot attend the meeting. Here, they are designating Prashant Patel, the president, as the proxy. If you are a registered shareholder, you can vote by internet, mail, or attend the virtual meeting. If your shares are held in street name, meaning through a broker, you'll get instructions from them on how to vote. For the meeting to be official, a quorum is needed. That means at least half of all the shares that can be voted must be represented, either by you attending virtually or by submitting a proxy. So that is about 1.3 million shares that need to be there. Here is a key point. If you don't give specific instructions on how to vote, your shares will be voted for all of the board's proposed items. This highlights how important it is to actually vote and make your choices clear. A broker non-vote happens when your broker votes your shares on routine matters, but not on non-routine ones, because you didn't give them instructions. For this company, they expect the name change, preferred stock authorization, incentive plan, and super voting preferred stock proposals to be non-routine. This means if you hold shares in street name and don't vote, your broker might not vote on these key proposals, effectively abstaining on your behalf. Now to the crucial part, how many votes are needed for each proposal? For proposals 1 through 4 and proposal 6, they need a majority of all outstanding shares to vote. For it, this is a higher bar than just a majority of votes cast. It means abstentions and broker non. Votes effectively count as against the proposal. For electing directors, it is the same story. A majority of outstanding shares is needed for each nominee. This means a lot of shares need to actively vote for these directors for them to be elected. An abstention means you are present, but you are choosing not to vote for or against a proposal. While it counts towards a quorum, it has the same effect as a no vote, because you need a majority of outstanding shares to approve something. Good news, your proxy is revocable. You can change your mind, you can submit a new proxy, send a written notice, or vote at the virtual meeting, and your latest vote will be the one that counts. Let's look at the people running the show. This section lists the directors and executive officers. Prashant Patel is listed as president. He has been on the board since 2022 and was reappointed president in late 2025. He has a background in pharmacy and the pharmaceutical supply chain. He is not considered independent due to his role. Sean Ajarapu is the chairman of the board, also serving since 2022. He has a really extensive background with experience in special purpose acquisition companies or SPACs and renewable energy. He currently serves on several public company boards. Donald Fell is a director who joined in 2025. He is also an independent director with a background in economics and has served on many other public company boards and academic institutions. Gary Herman joined the board in 2026 and is also an independent director. He has a strong investment and business background with experience in investment banking and managing investment funds, and currently serves on other public company boards. Marlene Velez has been a director since 2026. She brings over 20 years of executive leadership experience in operations, human capital, and business development, and also has experience in real estate and business advisory. It is important to note that Prashant Patel, Sean A.J. Jarapu, Donald Fell, Gary Herman, and Marlene Velez are all up for re-election as directors. The Audit Committee, which is responsible for overseeing financial reporting and the integrity of financial statements, consists of Gary Herman as chairman, Donald Fell, and Marlene Velez. Gary Herman is considered an Audit Committee financial expert. Donald Fell and Marlene Velez are on the Nominating and Compensation Committee, which handles executive compensation and board nominations. Now, let's talk compensation. This table shows what the named executive officers, or NEOs, were paid in 2025 and 2024. Brian Norton, the former CEO, received a substantial paycheck in 2025, with over $24 million primarily from stock awards. This indicates a significant equity grant before his departure. Timothy Canning, another former CEO, received about $936,000 in 2025. He resigned in February 2025. Prashant Patel, the current president, received about $5,882 in salary, but a massive $11.8 million in stock awards in 2025. Remember, he also had a base salary of $400,000 in 2024. This huge jump in stock awards for 2025 is a key point. Similarly, Sean Ajarapu, the chairman, also received about $5,882 in salary and $11.8 million in stock awards in 2025. His 2024 salary was $400,000. This pattern of low salary and high stock awards for Patel and Ajarapu in 2025 is very notable, suggesting a shift towards equity compensation. Srinikala, the Chief Information Officer, received just over $1 million in 2025, mostly from stock awards. He resigned in 2026. Charles Wilson, the former CUSO, got around $475,000 in 2025. Again, a large portion from stock awards. He resigned in March 2025. Mark DeSiena, former CFO, received about $237,000 in 2025. He resigned in October 2025. Vishnu Balu, another former CFO, received about $83,000 in 2025. He resigned in April 2025. And Eric Sherb, the current interim CFO, received about $42,000 in 2025. It is clear that 2025 was a big year for stock awards, especially for the top brass. The total compensation seems heavily weighted towards these equity grants, which are often used to incentivize long-term performance. Looking at the employment agreements, Sean Ajarapu and Prashant Patel both have agreements that started around late 2023 and were set to expire at the end of 2025. Their base salaries were around $400,000, with eligibility for bonuses. What is interesting is that the table shows their 2025 salary was much lower, at about $5,882. But they received massive stock awards. This suggests a restructuring of their compensation, moving away from salary toward equity, likely tied to the company's strategic shifts. The incentive plan itself aims to attract and retain talent through equity awards. The proposed amendment to raise the annual increase to 20% and add super voting preferred stock is a significant expansion of this plan. Currently, the plan has a share limit of over 43 million shares. The proposed changes will add to this, especially with the 20% annual increase starting in 2027 and the 6,000 super voting preferred shares. The board can amend the plan, but they need shareholder approval for some changes, which is why we're seeing these proposals now. Let's shift to director compensation for 2025. Donald Anderson, a former director, received significant compensation, with cash fees and substantial stock awards totaling over $725,000. Rebecca Shanahan, another former director, received about $690,000, also heavily weighted towards stock awards. Michael Peterson, a director, received cash and stock awards totaling over $242,000. Prashant Patel received a small cash amount of $7,500 for director fees in 2025, aligning with his role as president. But as we saw earlier, his main compensation came from other awards. Similarly, Shuran AJ Jarapu received $7,500 in director fees. The company's policy for non-employee directors is a cash retainer of $120,000 plus an annual equity award, but the table here shows different figures for 2025. This might be an older compensation structure or reflect specific agreements. Now, who actually owns the company? This table shows beneficial ownership as of the record date. Shuran Ajarapu directly owns over 356,000 shares, representing about 13.46% of the company. Prashant Patel owns around 319,800 shares, which is about 12.08%. Collectively, all directors and current executives own about 25.84% of the company. This is a pretty good insider ownership percentage, which can be a positive sign as it means management has a significant stake in the company's success. Brian Norton, the former CEO, still holds a substantial amount, over 364,000 shares, which is about 13.75%. However, they note that his ownership of some of these shares is subject to ongoing litigation, which is a definite risk factor. Let's circle back to the proposals. The name change to DataMeds AI Inc. is presented as a strategic move. They are a holding company with various subsidiaries focused on pharmaceuticals and healthcare services, and they want their name to reflect this broader tech and data-driven approach. Remember, this needs a majority of outstanding shares to pass. The authorization of 1 million shares of blank check preferred stock is about future flexibility. It allows the board to issue preferred stock in various series with different rights and preferences without needing repeated shareholder votes. This is a standard move for companies that anticipate needing significant future financing or strategic maneuvers. They do acknowledge that this type of authorization can have anti-takeover effects, meaning it could make it harder for an unwelcome outside party to take over the company. The amendment to the incentive plan is a big one. The move to a 20% annual increase in shares available for grants, along with reserving 6,000 super voting preferred shares, is a substantial boost to their equity compensation toolkit. For context, when companies significantly increase their equity pool, it is often to fuel aggressive growth through hiring or acquisitions, or sometimes to bridge a gap in cash flow by compensating employees with stock instead of cash. However, this level of increase, especially the 20% annual auto increase, does raise concerns about dilution for existing shareholders. The sheer amount of shares that could become available is considerable. Starting in 2027, there is an automatic 20% increase each year. This is a lot of potential dilution, and it's crucial shareholders understand this. This supervoting preferred stock proposal is the most intriguing, issuing shares with 10,000 votes each to directors and officers is a powerful move to solidify control. They claim it is to support long-term strategy and reduce execution risk. For example, if a large shareholder tried to push for a quick sale or a different direction, this super voting stock held by management could easily block it. This is similar to actions taken by companies like Alphabet, where different classes of stock give certain shareholders disproportionate voting power. The guardrails they mention, like transfer restrictions and sunset provisions, are meant to address governance concerns. But the fundamental concentration of voting power is still a major point to watch. The voting power is the key here. 10,000 votes per S-hair. If they issue all 6,000 shares, that is 60 million votes, which can easily override the votes of common shareholders, especially given the current outstanding share count of around 2.6 million. This also has implications for NASDAQ listing rules, suggesting the exchange is aware of the potential impact of this voting power shift. The filing explicitly states that this will concentrate voting power and make it harder for others to influence strategy. This is a direct acknowledgement of the control-preserving nature of this proposal. The election of directors is standard, but given the proposed changes, it is worth watching who is on the board and their alignment with these new strategies. Ratifying the auditor is routine, but it is good to see they're engaging Surrey & Company chartered accountants. The audit committee report confirms their oversight role. They've reviewed the financial statements and the independence of the auditors. Audit fees increased from $96,000 in 2024 to $154,000 in 2025. This isn't a dramatic jump, but it shows increased activity, which is expected as the company grows and potentially faces more complex audits with these new stock structures. Scrollno, looking at these proposals as a whole, the company is clearly setting itself up for a major transformation. The name change signals a pivot to AI and data. The equity plan expansion suggests aggressive growth plans, and the supervoting stock is a direct move to solidify insider control. For existing shareholders, the key concerns are the potential dilution from the expanded equity plan and the impact of concentrated voting power from the supervoting preferred stock. If this company is truly aiming for a big future in AI and healthcare tech, these moves provide them with the tools. However, it comes with a significant shift in governance and potential dilution risks that shareholders need to carefully consider. My biggest concern is the balance between management control through supervoting stock and genuine shareholder interests. What I am actually looking for is how this AI and data push translates to real revenue growth to justify the increased equity and control for insiders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. So scroll.